we've got, Europe everywhere you got predicted going into a recessionary environment, but it's shallower. And I think the GDP last quarter may push out that thought process a little bit longer. But there's no question when the rates have to go up this fast, you have to slow down the economy. You have to get inflation under control, whether it's the ECB commentary you were talking about earlier, whether it's Jay Powell's commentary in the Fed or the other Fed officials. And so we've got a recession predicted early to mid next year, and then coming back out the other side in the U.S. and worldwide is sort of the similar thing. But right now, you don't see the conditions because the employment's strong, the underlying activity is strong, the amount of stimulus that was put in is still in the markets, that people don't see it as a deep recession. There are danger zones, as people talk about, the escalation of the war, there's things. And then in Europe, obviously the energy question is much different than the U.S. The good news is the U.S. is a big economy. If we can get the energy to Europe for the people to heat their homes and industry to run, that would be a good thing. And I know all the companies that are working on it because I talked to them about it.
When you listen to us in the morning, or you see the Wall Street Journal headlines or the FT, what do you think we're missing? What is the missing piece of the is everybody too bearish? I mean, I know that there are other heads of banks in the States who are much more negative, I think, going forward than you are. But do you scream at the television sometimes and say what these guys are missing is X?
No, I think this is a could versus is. In other words, if you raise the rates and slow down the economy to fight inflation, the expectation is to have a slowdown in consumer spending. It hasn't happened yet. So it could happen, but it hasn't happened yet. You're seeing a mitigation of the rate of growth, not a slowdown, not a negative growth. So I think the issue that you see is in the current environment, actually everybody's saying the same things. My current situation, my consumer credit's strong, my commercial credit's strong, the consumers are spending, the unemployment is low, wage growth is strong, cash flow of accounts, our accounts under 50,000 is still positive or break even, which is still strong this late in the cycle. That's the thing. What happens next is everybody also says it'll be a recession because the impact of the Fed. The question then is where you get to the third element, which is what happens if other things that there's low probability but high impact happen. And that's where I think you see the people ironing out. We all worry about that last set of risks. The question is, you don't see those risks evidencing in behavior change of companies and consumers yet. People aren't laying off massive amounts of people. They're not hiring as many. So you hear people say, I'm going to slow down my hiring, but same with us. Well, I'm going to slow down my hiring to manage my expenses, but you don't see them. That's the debate that goes on. Is it the current environment? Is it the to come environment?
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.